Hey, Matteo, great to be with you again after 2 months. The book has been released finally, Failed Pivot Scale. We've been really excited. In just a short time, one matter of 2 months, it has become a big sensation throughout the world. I mean, we did a really great job at putting a playbook together. It's just a book, it's actually a playbook for investor magnetism, how to make investors chase you. And what's fascinating about this book really is like it's so easy to read. You know, most business books are really drawn out and the jargon just gets you tired and you want to put the book away, essentially, not read it. So this one is really what we've done here. Even have a glossary at the back of the book, and you can see it, see the glossary.
Yeah, the glossary is very important
Yeah, of the key
because
terms, because we know that people are not always book smart. Some people are more street smart than book smart. So you want to make sure that the terms, the jargons that still are in the book are still understandable for people. So what's your take on the book, Matteo? How it's been so far?
well, I had to say this that the book comes from effectively a journey that started in 2017 with a university for which I wrote a program for entrepreneur. But now in 2026, it became almost like inevitable to write it because there are big shifts in the economy right now. We live
Right.
more and more in intangible economies. And so the books is much more important, even more important for finance professionals in AI-driven economies. So yes, it became inevitable to write it after the shifts that we are watching right now in the economy.
And it's so practical with the way we've done it. And the core of the book is the high valuation triangle. Let's talk about that. What is it? And the 5 stages of the startup.
Yeah, the high valuation triangle is the system that was created in 2017. It's across different industry sizes and countries. I kept seeing the same thing. So how do you build businesses that are chased by customers, by banks, and by investors? And I say customer before I say banks and investors because the word valuation might displace many to think that it's just about a financial event. In actual fact, it's about building a business that is chased by customers. So the connection was that intellectual property protects value. You start selling value to customer, you don't sell on price. So when you sell on price, the customer will leave you on price, but when you sell on value, the customer will retain you on values. So the first goal when you build valuation is commercial, yeah, to have a very, very resilient business. Then the second side of the triangle is that succession transfers value. This is what investors really want. They want value transferability. They don't just want very hard work or efforts. And the other question that people, investors will ask in particular, how do you scale? And especially in AI-driven economies, this become such an important point because many people that tend to think that intellectual property is static. But today, with AI-driven economies, intellectual property is dynamic, and this is where global positioning scales value. And this is, you mentioned about the 5 phases. There are 5 phases in businesses in which this will play. Those 5 phases are startup, number one. Number two is scale up. Number three, stagnation. Number four, crisis. And number five, exit. So those are the 5 stages across which the high valuation triangle will play.
Essentially. And one question I want to ask you, Matteo, you've been on both sides of the chairs, both on the founder side and both on the executive side, and you've seen what founders get wrong. So business could be profitable, it can have revenue coming in, but it still cannot be investor attractive, let's say. So what are the common mistakes that founders make in this area?
Yeah, the common mistake we see is that the narrative has always been about growth is what really matters, revenue is important. But revenue without structure can actually increase risk. And I always say this that growth without structure is velocity towards risk. And risk is exactly what investors do not want to see as unnecessarily increasing. There is a rule with investor when the risk goes down, valuation goes up. when the risk goes up, valuation goes down. So basically, what tend to really be the trap for many founders is that growth can hide inefficiency, can also hide founder dependency, can hide poor margins, and can hide operational chaos as well. Some businesses are growing because the founder is pushing harder every year, but that's no scalability. I call this endurance. So valuation businesses are not just growing, they are becoming more transferable. And let's face it, we live in intangible economies where today, if you look at the S&P 500, 92% of the valuation is made by intangible, and intangible are usually not seen on financial statements. You do not see data, you do not see algorithm, you do not see the dynamic intellectual property that changes every day. That actually creates wealth, creates investability, it creates bankability, and it creates more lifetime value for your customers as well.
And the founder might say, my revenue is growing, customers are paying, Tim is busy. But if they don't have the right structure in place, they're completely on the wrong track when it comes to investor magnetism. Because investors want to know you have the structure, you have the legal system, you have the processes, everything ready for transferability.
Yeah, and this is basically many business can be profitable but fragile. Profitability does not equal resilience. Because example, you have one client concentration, you can have a founder that makes all decisions, you can have undocumented processes, no second line leadership, you can have pricing pressure, no recurring revenue, weak system, and poor cash predictability. So what I would always say is that a business can look profitable on paper, but still feel emotionally expensive to acquire. Why am I saying that? Is because investor will ask what breaks if the founder disappears, what happens under pressure, how predictable is the future. These are all questions that really matter.
The core is really founder-driven businesses. They really make sure that there's no exit. They don't plan the exit ahead. I think that's key in what we talk in the book. You have to plan for the exit, even if you don't think of exiting. Let's think about that more.
Yeah, exit. I mean, there's a lot of space on the book about exit because we talk about this as effectively a position you need to have, not because you're gonna sell, or even if you're never gonna sell. I've seen every other day maybe situations where owners are trying to exit and there's no preparation. Exits are rarely created in the final negotiation. They're actually created years earlier through architecture. And I insist on this. It's about you design. Many people, they think finance professional are not designer, they're not engineer. But the answer is yes, they are, because you want to make sure that you have a premium exit, and that can be worth millions and millions and millions. And an exit premium exit require all the qualities with the high valuation triangle that are needed to build a business that is chased by customer, by banks, and by investor. So what premium exits really require is a number of things. First of all, again, transferability. They require governance. No one wants to buy a business that chaotic effectively. Premium exit require also system. They require leadership depth. They require recurring revenues. They require defensibility, documentation, strategic positioning. The best exits really happen when buyers feel that they are acquiring momentum. They're not inheriting dependence. There is a big difference between two words which are the opposite of each other. One is dependency, the other one is optionality. They are the opposite of each other, and guess which one you should really go for? Of course, it's optionality.
Also in the book, how we should build a culture of where you're building the next leaders. So the business essentially becomes less founder dependent and more attractive to an investor. Let's talk about that more. We give examples of Microsoft and others in the book, a lot of examples.
Yeah, I mean, this is where I was mentioning earlier on about dependency. When a business starts, it usually starts and it continue to exist because there is control. The founder has got control. However, when the business scales and it needs to become attractive to investors and to banks, that same control becomes the reason why it's impossible to scale. This is why founders should really look for a change of identity. I would say this complete change of identity. When somebody tells me, does a founder need a mentor? And the answer is probably almost always yes, a mentor or a coach, because you have to change your own identity. You need to become totally different, a totally different person to the business. I always use what I call it the comparison to sports. Football is a very popular comparison. It's an analogy, let's say that. So when
So in America, we're talking about soccer.
Soccer, let's talk about soccer for Europe and even American football. It's any sports you like. You can also talk about rugby. So you become a coach. You're no longer playing on the field because you used to play on the field every position when you start the business. But when you want to scale, you are the coach, you are the CEO. And now you need to really find the right leaders. So I tend to simplify this in three leaders: the attacking force, which is usually the commercial force of the business, the sales, effectively, because you need to score goals. Then the midfield force, which is playing the ball around, moving the ball around, creating opportunities, of course, because you need to sell, but you also need to produce what you're going to sell. And then on the back, you have usually what I normally do personally as a CFO. You tend to defend, make sure you don't concede as many goals as you scored. And so that means generating cash flow. Founder dependency is usually created from care, not from ego. Okay. So many people say, well, people are egocentric. Just because you care a lot. The founder solved every problem early on, but eventually what happens with that is decision making centralizes, relationships centralize, culture centralizes, sales centralizes, everything centralizes. At some point, the founder stops being the engine of growth and becomes, unfortunately, the bottleneck to transferability. In the book, actually, in the second chapter, you will find a bottleneck map. So it's very, very interesting for many people to see if they conform to that picture, which is, I think it's page 40, between page 48 and page 50 as well.
Also, when I talk about this, founders, they see the late nights, they see the pressure, they see the sacrifices, the momentum, but what does actually capital look at when they look at your business specifically? We talk about the structure, the legal process, the IP. Would you more elaborate on that, Theo, as we told also in the book?
This is where the high valuation triangle provides three big answers to three big questions. The high valuation triangle has three sides. One is intellectual property, two is succession planning, three is global scalability. So side number one, intellectual property, will answer a question from an investor. The question is, what do you own? Okay. Because if you do not own anything, then unfortunately, that's where you will start to lose investor interest.
Most founders miss out where they don't patent the process, they don't trademark, they don't make sure that their brand name is even registered. We can do this later thinking, which costs them a later on,
Yeah,
mistake.
founders, and I would say not just founders, they confuse legal IP with commercial IP, and they also confuse static IP with dynamic IP. Two very, very different things. Especially with artificial intelligence, this subject cannot be deferred. You have to really own it 100%. So intellectual property, everyone owns intellectual property. Even solopreneur, even consultant, they own intellectual property. They just do not know what the difference is between these things. So the first question that we answer from investor is, what do you own? And that's the first side of the high valuation triangle. The second question that investors will ask you is, how does it transfer value? So now that you've answered the first question, what do you own? You have to answer the second question, how do you transfer value? And the answer is the second side of the high valuation triangle, which is leadership depth, succession planning. You need to design the business so that it transfers value through the leaders I've spoken about earlier on about football as an example. The third question to be answered is, how does it scale? Because if you're looking at money from investor, each next dollars must generate more money than the previous dollar. Now, global scalability, and the book mentions quite so many examples of how to do this through also blue chip organization like Apple, like Exxon, like IBM. You scale globally by going back to the side number one, which is intellectual property. There are four ways to do this in global markets, and the example come from American economies in particular. Regrettably, Europe, for example, has not really kept pace with the USA when it comes to global scalability example. Usually American companies, the biggest one that we know about, they found a way to become globally scalable with a different method for different countries. For example, McDonald's, an example that many people will know about, has done it through franchising. I'll give you another example. Starbucks done it in a different way. It's done it through joint venture. Companies like Nike, like Gillette, they've done it through distribution. Now, there are different ways to do this. And what's the end goal? Investors will obviously be investing in your business because they can see scalability. But let's not forget about the benefit for all of us. By following this example, especially the American example, we create jobs, we create a better economy, better wealth. I wrote an article about Europe being still stuck in 1975 when most of the value of the businesses was tangible, not intangible. It's a big issue in my view. It goes really to the heart of the reasons why Europe does not produce competitors to businesses like Apple, like Nvidia, like Microsoft. There is not a comparison, a comparable business like that in Europe.
How do, let's say, companies quietly use their valuation, even when the founder or the business owner thinks everything looks fine on paper and everything's coming in, everything's flowing, everything looks all right? What are they not seeing, let's say, that quietly erodes their valuation?
Yeah, the biggest pitfall is to just refer back to the financial statements, which will tell you very little about what makes your business valuable. The examples very, very numerous. I could tell you about what I like to call it actually the hidden discount. I'll give you some example, but there are so many. For example, undocumented intellectual property, typical example. If it's not documented, it's not really worth money or it's not worth the investor's attention. And you need to follow the right sequence with IP. You document it after you identify and before you protect it. And the other thing which is important, you do not commercialize it until you protect it. Unfortunately, many people do the opposite.
With China involved, you have to be very,
Yeah.
very careful.
First, you protect it, especially in AI driven economies, and then you commercialize it. And after that, you make it transferable. Now, the other example of a hidden discount is poor reporting. Unfortunately, founders underestimate the importance of financial intelligence. Financial intelligence is what really investors back. The other thing is inconsistent pricing. So you do not have a system that dictates how you're going to price what you sell.
Matteo, let's go back. Financial intelligence. What does financial intelligence looks like to your business? How do you see a financially intelligent business? And what does the investor see as financially intelligent business? If you can elaborate more on that before we move on.
Yeah, financial intelligence is this core. It's about really having the right financial structure in the business, but also the structure in general. And it means execution in a manner that is not emotional, first of all. So when you execute your business, you execute based on a real financial plan that makes you accountable. And financial intelligence is also about, for example, the right capital stack. Now, the right capital stack means, for example, working capital is managed. There's no reaction. The right capital allocation, the right judgment about whether, for example, certain initiatives should be abandoned. Example metrics like lifetime value divided by customer acquisition cost. So financial intelligence also means pricing for value, not for cost. So pricing for value means it's not just a commercial decision. If you are generating an economic benefit to your customer and that economic benefit lasts for the long term, then you know you own intellectual property. You own commercially valuable intellectual property. And financial intelligence should be at the core of this, should be absolutely, should be really architecting together with the commercial team the right pricing. So inconsistent pricing was an example of a hidden discount, for example. I hope I answer your question, Simon.
Yeah, I just want to say that just like you have a credit score where the credit bureaus look at your how you're handling your money, also the investors they want to see, let's say in the time of crisis, how you're handling failure and how you're pivoting, fail, pivot, scale, the main title of the book. They want to see how you're managing these situations, like how you're turning around basically the business. This is also part of your financial intelligence. Am I right on this, Matteo? I think you can add more to this.
Yeah. There are big example of situations. There are situations where the business is not performing as it should, and this is where execution needs to be done without emotion. What I mean, execution without emotion. The real cost of executing with emotion is huge. And I always say that great strategies are everywhere, but great execution is very rare. There are three main reasons why this happens. When you pivot, you need to avoid these three common pitfalls. One is to be attached. So don't be attached to what you've decided in the past and what doesn't work now. So attachment needs to be removed. The second typical behavior to be eliminated is fear. Sometimes the decisions, execution is emotionally driven by fear. And fear is where the wrong decision will be made, unfortunately. That happens more frequently when people dare to meet. The other common trait is avoidance. Founders tend to think that they need to avoid a problem when they should actually go and really try and resolve it. So to me, pivoting means really to executing without emotion, changing direction decisively. Decisively. That's a very important word. You fail smart, let's call it like that, or fast, depending on the situation. You pivot decisively, and when you scale strategically.
Let's tie this back to the high valuation triangle we talked about. It consists of IP, succession, and global positioning. What do you keep seeing in real businesses that make these three levels so important?
Yeah, these three levels are so important because they attract customers, banks, and investors at the same time. They attract customers because you sell the customer lifetime value. You do not sell a one-off benefit to a customer. And the lifetime value is what really generates when we say, or the right wording is royalties, licensing, the premium. And it makes customers really stick to your business. So intellectual property monetization through its 5 steps. The 5 steps are identification, codification, protection, commercially embedding, and transferability. So these are the 5 things that matter commercially now to any business, regardless of exit plan. So make sure you know what intellectual property can really do for your business, because that's how successful businesses like Apple, Microsoft, Lego, but even the smallest businesses that could be your neighbor is actually doing right now. Succession planning is fundamental because it allows the business to use what many people they would call it the eighth wonder of the world. And it's leverage. Leverage means it's a lot more than just an idea, it's just one founder. It's about really a team that's been created, a company that has execution capability. And once you've done these two things well, what you're left to do, especially in artificial intelligence driven economy, is global positioning. Because today, with artificial intelligence, you cannot postpone that discussion. For starter, your intellectual property is dynamic, it's not static. And you will not find it on financial statements, unfortunately, because that's where many people mistake information with real transformation. So you will not be able to find out. You will have to transform your intellectual property every day. And it's something that you'll have to learn to do that, because with AI, your data should, for example, produce algorithm. Your algorithm should produce outcomes. Those outcomes are what you sell to your customers, for example. So this is where global positioning is not avoidable anymore. You need to have a natively global business.
Let's dive back into IP, if you will. Most founders think of intellectual property and IP, and they think it's not for me. I don't have patents. But what does hidden IP usually live inside an ordinary business? How we can identify what to patent and monetize?
Yeah, I mean, intellectual property goes well beyond what you think you can do or you're doing already. Even your unique thinking, your unique way to solve problems, your unique frameworks, your contract structure, your standardized pricing, your outcome-based pricing. Yeah. For example, if you developed, I'll give you an example of a business that that really stayed with me quite a few years ago. If you develop a system that saves an organization time or will increase the revenue, if you develop that system, even if you have not patented it, that's your intellectual property. You own it, you deliver it. Of course, you have to protect it and you have to commercially embed it in your business. In some situation, that would be sold through licensing, through royalties. Another example, let's say COVID vaccine. I'll give another example where Pfizer and BioNTech, they joined forces together to create their own, well, to actually monetize their own intellectual property together. Yeah, this is where there's a vast discussion to be had. But generally speaking, do not think about intellectual property as something that is just patented.
So we're back. Now let's continue with early mistakes that become expensive later. What are the small things founders fail to protect, document, or structure early and later become painful during fundraising, due diligence, or exit? Let's talk about that.
Yeah, I mean, there are several patterns here. One of the patterns is to follow the wrong sequence when it comes to intellectual property. Example, you have a unique proposition for your customer and you commercialize it before you protect it. Now, especially in AI-driven economies, this becomes a big issue because when you sell value to a customer, that value must have been protected before it's commercialized. Okay. So that's how you really make sure that you create the right value from the outset. The other pitfall we see all the time is that they bring in financial intelligence when it's too late, when they have to resolve a problem. They think the valuation is an event. Valuation is something you design, you engineer. You don't just one day do a calculation on your financial statements. And this is where you will find that the presence of financial intelligence in a business can be worth so much more than the cost of its presence. The cost of the absence of financial intelligence is huge. Unfortunately, many people underestimate it. Example, how do you intelligently calculate the customer acquisition cost compared to your lifetime value? How do you report this to bank? How do you stress test scenario? How do you become less optimistic about forecasting your revenue? This is where many people, unfortunately, many founders, they make mistakes. Even after there is capital, they assume that the runaway will last less than it will eventually. So this is where you will see many pitfalls. At its core, yeah, it's all about, in my view, it's mostly about lack of financial intelligence, lack of understanding that financial intelligence is a fundamental ingredient for wealth creation.
Also leads us to stagnation. When business plateaus, founders often blame marketing, sales, or the market. What are they usually not brave enough to look at? An honest question to ask.
Yeah, this is where when you are in the middle of executing a strategy, you always have to think about failed people scale effectively because the strategy will find some roadblock and that's where you pivot. That's where you learn to pivot. And this happens probably more frequently than many people think. So you fail at one strategy, you fail at one customer segment, then you iterate so that you can actually become more ready for the right commercial outcome. So this can happen many times. And the way in which you react with financial intelligence is that, let's say you have a plan, forecast, let's say 12 months in front of you, you got a runaway, and you have planned to spend some money on marketing and budget, but let's say the sales are not coming as early as they should. You should be flexible enough to establish whether the marketing, the sales expenditure should be postponed or should become more depending on how the sales will perform. And this is not something you do by asking your accountant to pull out a financial statement because financial statements are history. They tell you what happened. You have to design the future. And the future doesn't mean the next 10 years. You have to design next week, next month. You do not do that by simply following a playbook or following just a document that was established when the variable were not certain and they will never be certain in any case. So that I'll give you an example of that.
Let's talk about market ceiling. What happens when you're being disabled in one market stops being proof of success and start becoming a limitation? The next step of the high valuation triangle, where we talk about actually the third step, going global.
Yeah, from the moment you start designing your business, which is why even if you're not in a startup phase, you should read the full book. There are self-assessment. Each chapter has a self-assessment that will allow you to really evaluate your business against a certain value, certain factor of valuation as well. So this is where you need to think as soon as you can, obviously, to have different revenue streams. So the goal of the high valuation triangle is to add revenue streams. So you own intellectual property. Now you know that you should add revenue stream. I'll give you the example of consultant or solopreneur, for example, who may be listening to us today. If you have the ability to serve your customer by giving them the right transformation, one-off transformation, then you should also be able to serve your customer with additional product. Example, those products, they could be additional toolkits, they could be additional tactical tools, additional important frequently asked question, for example. So just give you a very simple example, because I know there are many consultants out there who want to know how to monetize their intellectual property. But each business should follow these in any case. You should build resilience through additional revenue streams. And in times of crisis or in times of stagnation, when you're looking for a global solution, you should go back really to the first side of the evaluation triangle, understanding what do you own, because what you own will determine what strategy you need to use. Example, if you own products that might sell very well in a particular country, then you may want to think about establishing some distribution deals with certain distributor. Obviously, it could go on and on. Each situation is unique. Yeah.
So we talked about a bit about crisis, and when cash is tight, confidence is low, decisions feel heavy. What's the first thing the founder or the business owner should stabilize first, besides recognize what they own? What do you think is the right decision?
The first thing is to preserve two big important qualities any business should always have: positioning and structure. The businesses that come out of crisis better are the businesses that are more understandable. Nothing glamorous about this, really. I know that many people think, oh, this is not really what I was expecting, but really, the more understandable your business is, the more your business is capable of going through a crisis. And during crisis, the other big advice I would give is to always understanding that time is really tight. So a decision cannot be postponed. You need to be more resilient. But that's why if you have built your positioning and your structure and you know what you own, your intellectual property, you know how you could potentially deploy what you own into a crisis.
So we say understandable. What do you mean by exactly business is more understandable?
Business that is simple to understand to your customer, to your banks, and to your investor. So if you can describe it in a manner that makes sense to your bank, your investor, and your customer, and your product is obviously got a market, not only a product has still a market, but you have the ability to introduce new revenue streams as well.
Let's now define part, the exit. You make a PowerPoint point in the book that exits are earned long before the buyer shows up. What does a founder need to build years in advance so they are not negotiating from weekends later?
Yeah, at exit is when the high valuation triangle will stop being a tool to operate your business, but it will be what reveals the value of your business. It's a revelation. It's not building it anymore because it's too late to build. Because when you exit, you know that the number, the valuation number, depends on thousands and thousands of action you have taken before the exit. So when it comes to the exit, it boils down to three phases effectively. It's preparation, negotiation, and execution. This is where, again, not only the high valuation triangle is fundamental because it will drive you towards the highest possible exit value, but also you want to build optionality. Optionality means that you don't just have a buyer for your business. And this is where I've actually built a program lately, 12 outcomes in 49 days, where you build the right structure for your deal as well. So the right structure will happen when you, as a founder who's going to exit, knows that you are going to be able to negotiate in the best possible position. So, for example, you don't just look at the number that is put in front of you. You also look at the terms and condition. Example, what about earnout? What about you give up control too early about what makes your exit positive or not positive? Unfortunately, many founders, they relinquish complete control of the driver of the exit. And no wonder they are unable to profit from it.
Be willing to walk away in the book if the deal doesn't sound to be too needy. You always be willing to negotiate your part. And when you're transferring the business, you can also negotiate a consultant fee where you're guiding the new management or the new owner in how to manage the business. So you're not everything giving away everything at the first take, let's say. You're slowly exiting the whole business to ensure the employee welfare, the business welfare, transferability on a positive note.
Yeah, exactly. And usually when you exit, it's about really leaving your legacy as well. The book also talks a lot about the transformation needed to be able to exit, because after the exit, you may feel a totally different person. Another change of identity is needed. That change of identity is not easy for many.
We talk about in the book, also my part, where you take a bit kind of like a detox. You don't do, new adventure, and you don't take a new business. You just take a time to reflect and see how you move forward. Because when the time you were you were running the business, you were doing everything. Maybe you were in a key position in the business. You were essentially the engine. Even if you had transferability insured, but the business was essentially your baby. It was part of your identity. Now you have to kind of reflect and detach and see who you are without the business and what can you become and what can you create later.
Yeah, exactly. And this is fundamental because you don't want to squander a chance that only happens once in your lifetime. So you want to make sure that you do the right preparation and the right execution as well. And that can take at least 1 year or usually more. And don't forget this, the valuation on exit is not something that you can engineer in just a few weeks or months. It's something that you engineer a new design over the many years you've been running your business.
And I think let's also maybe cover the common red flags investors look at and how to fix them. We can cover that shortly. We can cover it in LinkedIn in the book, but I think it should be very valuable for the listeners here.
Yeah, absolutely. This is where the last few chapters of the book, they are dedicated to this as well. There are quite a few self-assessment on the book. There are 26 self-assessment. My suggestion really for those who are reading it is to not just look at those chapters when they want to know about exit. They should go through as many self-assessments as possible. The beauty about this book is that you're gonna read it, you're gonna implement it. It's not just about reading, it's not about feeling good. But what you will find is that the self-assessment, you will be able to go back to them as frequently as you need so that you know what is your position about your best possible outcome. Example, in one of the chapters of the book, one of the last few chapters, I created a table where the table shows what kind of behaviors, what kind of expectation you should have in front of which buyers. Okay, so one meta is to behave in front of a venture capitalist. Another one is in front of a high net worth individual, for example. So you want to make sure you behave differently according to who the buyer is.
Yeah. Know your buyer, definitely.
Yeah, so
And
that's a very important matter. Yeah.
yeah, and to wrap this up, Matteo, what would it take for an investor or a buyer to say to stop asking what are the risks here and instead ask how do we get in?
How do we get in? Well, I always mention about the concept of risk asymmetry. Risk asymmetry means, in a few words, effectively, you measure and mitigate the downside, but you also measure and maximize your upside, because businesses will never exist without risk. In actual fact, the business exists because someone took a risk. So that risk is what makes that business exist. And so long as you haven't sold your business, there's always a risk. So make sure that when you speak to banks, when you speak to investor, you understand what risk asymmetry is all about. Trust me, that knowledge and that attitude could be worth millions and millions in your favor.
Absolutely. Okay, Matteo, it has been really great to make this interview with you together. For everybody listening, definitely get our book, Fail Pivot Scale, and definitely go over the self-assessment. Each chapter in the book has the self-assessment, which is really priceless. We can see here one of it, self-assessment. Can we see it? Yes. So, which is really priceless. And, great teachers are the ones who get the student or the practitioner to get to the best conclusions by asking the right questions. So in the way, this is what these self-assessments do. And this is our message, our hope that use this wisely and use it as frequently as possible, as Matteo said, to get the best out of the book. It's been great having the show with you, Matteo, and having this interview. And well, let's see what the future holds.
Thank you so much. And by the way, let's not forget about you as well, because you have helped me to write the book. You made it possible for also non-financially educated people to understand it better through your editing, through your action. So, everyone should be grateful to you as well, not just me, because you made that communication of the book so much easier to understand. Yeah.
Yeah, this book can be read easily in a week, maybe less if you have the time for it. I know most business books you take maybe ages to read because of the way they're written. But yeah, thank you. I have done that part well, I'm sure. Thank you, Matteo.
You're welcome. Thank you.